So, good morning, everybody. I think, firstly, thank you for coming here Tuesday morning for listening to the landscape of cash transfers in our country. Before I get into the report, I'll just share a little bit of who we are and how did we get into this space. So, Muzamil and I founded Project Deep 3 years ago. Uh, it was a culmination of a couple of things. Both of us have been in the impact space and had our own sort of ruminations about impact, about efficiency, and that led us to exploring spaces of cash transfers. Give Directly, which is the biggest US-based NGO, has been doing programs with philanthropic capital in Africa and other developing countries, and that piqued our interest. And then around COVID, a lot of countries were picking it up as as a model of aid, because there was no other way of reaching the people who were in need. That's when we got to thinking that why just in a crisis mode? Like why can't we explore cash transfers as something more than just crisis response? I know today it sounds like, what am I saying? But 3 years ago, the conversation was not so big. Like obviously there were government schemes, some farmer-centric schemes, pensions have existed, but the big wave that we've seen is pretty recent in the last 3 to 5 years, especially the conversation around it. So when we started off, our objective was like, how do we increase the adoption of cash transfers? How do we get the conversation going? It happened by itself. We continue to do our field work. But the political narrative picked up pretty strongly. And so now we have expanded our focus to say that apart from community work, how do we also influence policy into more intentional design, into more sustainable financing? Um, what sort of fuels our understanding is our field work. We have also in the past couple of years raised philanthropic capital to actually implement programs on the field. Again, inspired by Give Directly, what we looked at was that while the government provides monthly transfers, what happens if you provide a bigger lump sum altogether? What happens if you give almost 70, 80 or 90% of the family's annual income in one go to them? With no strings attached, right? There's no financial literacy. There's no advice given on, prioritize livelihood or prioritize health. It's completely no strings attached. And unsurprisingly, it was mostly used for asset building. I mean, when you just think about it, that if we were given a big amount of money, then you would kind of prioritize what you can't do with your existing wages or what you have kind of parked for a future aspiration to say, when I have enough money, I'll do this. These are just the stats to say that assets have been like housing, agriculture, water, non-agricultural livelihoods. This includes stuff like investing in land, investing in water sources, investing in livestock, making houses or shelters for livestock. We've also categorized debt repayment as assets because when they repay debt, they're able to release collateral, which is either their land or which is their jewelry, which becomes unproductive when it is pawned off to the money lender. Some of the stories have also been very inspiring because we're also linking this to aspirations. We're also linking this to well-being. When I say aspirations, what I mean is that in our first project, about 8 landless farmers were able to take land on rent for the first time. And what we observed is that while microcapital or other forms of debt existed, that doesn't allow people the risk-taking ability, right? Like a lot of focus is on repayment of the money, and then it kind of takes away from the developmental focus that you can have. But when you have, like, this is almost like a risk capital to a new company, right? It's seed money, so you can do whatever you want with it. And therefore, we saw that people were able to be more creative, more imaginative with the way that they use the money. And so this is the hypothesis that we have been working with to say that in our country, there is still a lot of population that is struggling with building the foundational assets. A lot of the distress comes from not having housing or a clear source of livelihood. And so while cash transfers from the government have been used to provide a safety net to ease consumption, are there different ways that we can look at it? Are there innovative models that we can also plug and play within this space, right? So this has been our work for the past few years. As like I mentioned, because the policy space has picked this model up in a big way, we also thought that it would be useful to deep dive into how the government thinks about it by mapping out the landscape of the last, 10 to 15 years to say that what has been the movement, like what were the different inflection points where unconditional cash transfers became such a big conversation? What are the big schemes that dominate this space? How are they designed? Who are they reaching? So now I'll get into the report. This is intentionally a little bit of a reading deck. Even if you can't read it immediately, we'll share it with you, but I'll speak through some of the slides. It also has annexures of the detailed tables because I know that was of interest. But again, we'll share this and the report with you. So there's no sort of, you don't have to look at it right here and sort of memorize it or anything. So just to start off with, we can share the methodology is that we've looked at when we speak to people as an organization, we end up speaking to funders, NGOs, other stakeholders. There is a lot of confusion on what exactly a UCT is. Like, what is an unconditional cash transfer within direct cash transfers, and how are direct cash transfers different from subsidies? So we thought that the report would be a good place to put out this understanding, put out the definitions more specifically, so that also the reading of the report becomes easier, because the report is only focused on UCTs, not the entire gamut of conditional cash transfers and others. And we were able to find 71 schemes over different periods of time. However, budgetary data is available in a lot of varying degrees. Like sometimes it's available for a few years, the scheme gets merged with something else, it may not be available. We also looked at how UCT fits within the overall welfare space. Like, how does it fit within, like, how has the trend been compared to other flagship programs of the government? How has it been compared to the overall liabilities of the government? And then finally, what really provided us really deep insights was primary research. So we spoke to about 21 experts ranging from practitioners, economists, policymakers, to really get their perspective on what the movement has been and what they look forward to in when we talk about cash transfers. Some of the disclaimers are that this is very point-in-time data. And this is drawing for some of our conversation last time, we still don't have a deep dive into from launch to actual implementation, how much time does it take and how have different states been able to do it. But the report is a foundation for us. Now we intend to pick up either different schemes or states and then do further deep dives to understand this better. So first, and some of you may be aware of this, but just to set it in context, is that the country has moved from purely focusing on subsidies to looking at DBT. In 2013, the DBT mission was sort of initiated with the objective of reaching the citizens directly, to improve efficiency, to kind of cut down the leakages that are there in providing welfare. And then DBT is also of two kinds. You have in-kind transfers like your PDS, and then you have DCTs, which are directly cash transfers provided into the citizen's bank account. What this report focuses on is unconditional cash transfers. So within cash transfers as well, we've looked at coverage, periodicity, and conditionality. There are very few schemes even around the world that are purely universal, which means to every individual. So UBI, the monolithic definition that we know, which is to all individuals, periodic and in cash, that doesn't really exist anywhere in the world per se. But then you have universal within demographics, like all women or all farmers. That's what India is leaning towards more so. Within periodic, again, like I mentioned, monthly is something that is easier to administer. It also provides economic certainty to the citizen, right? In a country like ours, where a lot of the workforce is informally employed and wages are uncertain, this is a way of saying that at least a specific amount is going to come into your bank account every month. And conditional and unconditional, I think conditional are, where behavioral constraints are put upon a person either before or after receiving. So you need to kind of deliver in the hospital to be able to receive an amount, or you receive the amount and you have to pay school fees or college fees. But unconditional is where you're kind of not required to fulfill any conditions before or after. So to reiterate, the slides from here on are focused on unconditional cash transfers. They could be regular, one-time or targeted, but it's only focused on unconditional transfers. when we look at the evolution of UCTs, we look at it in three big phases. While pensions and some schemes have been around for much longer, we've mapped it from more like 2007, like looked at the last 20 years. I think the conversation started with this entire conversation on efficiency when this is pre-Aadhaar, when it was said that to deliver 1 rupee of PDS, you had to spend 3 rupees, like the government had to spend 3 rupees. And that's when there was a lot of conversation around building more efficiency into the system. And Arvind Subramaniam's paper on cash transfers for the poor really puts this out as a solution to say, how do you bring DCTs into the gamut? It is around this phase that all of the railroads, like we call it, of enabling us to do DCTs at this scale were laid out. Like you had your Aadhaar, you had DBT mission. And while zero balance accounts existed even before Jan Dhan Yojana really got the big push, and you saw implementation happening at scale. And then there was that, Arvind Subramaniam's paper, like you can time it with that LPG also moved from a subsidy model to more of a cash transfer model. And so that's sort of the first phase where it's more conversation, testing, pilot. In 2018-19 is when a lot of the farmer-centric schemes picked up. So you see that Raitu Bandhu is what came up in response to the agrarian crisis almost, to say that is there a way to provide investment support to farmers? And therefore, these schemes are also designed accordingly, typically provided before the 2 sowing seasons. These are again not tied to agricultural use, but they are only labeled as such and timed. So the design is in a way that enables usage for livelihood purposes, but it's not conditional. It doesn't say that if you don't use it, you will stop getting this money. PM Kisan, conversely, simplified the model, and therefore you get it 3 times a year at different periodicity, 2,000 rupees. But this really brought about the shift to saying that can we reach a larger part of the population with direct cash transfers and unconditional cash transfers? I think here is where the unconditionality element pretty much got cemented in the policy space. And then the more recent one is from 2019, which I think most of us are more aware about because you see it making news every other day. It started off with, it started off in 2 places. In MP, Ladli Bahin started off as a response to being able to provide better nutrition to the family by providing money to the woman of the household. And at around 2019-2020 in Tamil Nadu, there was also a conversation on compensating women for unpaid labor. While it didn't happen in Tamil Nadu immediately, but it sparked the conversation. Even now, there are debates about whether these schemes should be considered as compensation or not, because obviously when you tie it to compensation, you're putting a value to the unpaid labor, and that can be debated. Like, is it really just 1,000 rupees a month? And, that's not really something that sits well. But that conversation aside, the model picked the fancy. So you see after MP's success, a whole host of states have picked up. The model is similar across different states where it's monthly transfers to women from low-income households. But then there are certain nuances. The amounts vary from 1,000 to 2,500. The targeting varies based on, like, is it less than 2 lakhs a month or less than 2.5 lakhs a month of annual household income. But largely it is sort of being picked up as is. We'll get into some of the outliers in the subsequent slides. At Deep, like I said, because we had been implementing some of these models ourselves, it took us a lot of global research to arrive at what makes a scheme design, powerful or more intentional for impact. And we said that we would look at 4 things, which is frequency, amount, communication, and timing. Frequency is what I covered in the previous slide as well, that can you kind of pick out the periods where there is more distress? Can you pick out the periods where the need for money is higher for certain outcome areas? And if the objective is to provide economic certainty or to smoothen consumption, then monthly transfers work better. In terms of amount as well, how do you sort of map the amount to what the need is and to what the scheme objective is? So are the amounts that are being provided right now adequate? And how should they change? Like, there have been different theories, like like Karthik Muralidharan's IGD paper links it to inflation so that there is an automatic increase. Whereas for some, there are some sort of experts who don't think it needs to be increased every year and it should be mapped to the specific objective of the scheme. If it's for input prices, then it should just be mapped to that kind of thing. Communication is something that is very interesting for us. If you look at all the women-centric schemes, they talk about Ladki Bahin, Ladli Bahin. So it's more of the state needing to protect their sister. It's not a very empowering narrative. It's a more protection narrative. Whereas the objectives of the scheme have been financial empowerment and, providing that kind of boost to women in certain way, except Tamil Nadu, which actually calls the scheme Women's Right. And so we've been trying to look at how does the name of the scheme influence the uptake and the spending, because this is pretty unique to women's schemes. The farmer support schemes are very straightforward. It is called farmer support or Krishak Bandhu, which means farmer's friend. But women-centric schemes have seen this whole different narrative. There are pros and cons. We also hear that this narrative helps for women to safeguard their money, to say that, this is provided by my brother. I mean, as I don't know how that sounds, but when we go on field, this is what we hear, that because my brother has provided it, nobody else asks for it and I'm able to use it myself. So I think the way we think about it versus the way it is translating on ground needs to be examined further. And timing, like I covered within frequency itself, those two kind of go hand in hand. Is that what is the time when most amount of money is needed? And it varies for different groups of people. So how do we identify that when we are targeting specific schemes? So these two, like the timeline and these FACT, is what we're using in the subsequent slides to kind of analyze different schemes. We'll start with a budgetary kind of deep dive. The entire quantum is 280,000 crores, which is a huge amount in 24-25 that has been allocated to cash transfers. This amount itself was like a huge number for us because it's almost close to 1% of the GDP. It has seen a 23x growth in the last 10 years, owing to all of these different schemes. And this growth has primarily been through more states picking up. 10 years ago, it was the more central schemes that were kind of being introduced, but now it is state schemes that are also, having their share in the total pie. And even within social sector spending, it's a huge 11%. This number is also important because in our opinion, this is only likely to go up. Like even now we see that with Bihar elections, it is being promised that they will provide 2,500 to women. And we think that with every subsequent election, states are going to kind of pick this up. So how do we make it a little bit more intentional? Again, like I said, these are some reading slides and I'll share it with you later. But pretty much saying the same thing, that it has grown from a really small percentage of the GDP to really quickly picking up. We also see an uptick in 2020-21 when the 3 months cash transfer had been introduced, like 500 rupees to all women when the peak of COVID was going on. That shows why there was a spike there. And then that was a temporary scheme. So you again see a dip and it starts picking up again. I'll run through some of these quickly because I covered it in the summary slides. But what you do see here is that the spending by the states and the number of schemes also by the states have gone up sharply. These are primarily either women-centric or farmer-centric schemes. A lot of other demographic groups have not necessarily been included in this conversation yet. And the central schemes kind of have almost tapered in some way, like that you have PM Kisan, you have pensions, and you have Matru Vandan Yojana, and there are not many new schemes or amount revisions happening in the central share of schemes. When we look at the split by demographic, we see that women-centered schemes have now hold 54% of the total share. And this is for 2 reasons. The 2 reasons being that there are 14 states that have introduced schemes for women. Like farmer-centric schemes are restricted to 4 or 5 states. And also states like Maharashtra, where the schemes are reaching more than 2 crore women, 2.4 crore women, and therefore the budget itself is massive. So Maharashtra has a 36,000 crore budget just for women-centered schemes, whereas the center has a 60,000 crore budget for PM Kisan. So you can see that it's more than half just by one state. And so that kind of disproportionately increases the amount of money being allocated to women-centric schemes. Vulnerability-based schemes are typically the ones that are to address a very specific condition or a specific point in time in a person's life. So this includes stuff like pension for senior citizens, for people with disabilities, for widows. Yeah, so I think women-centric schemes, like I was saying, take up the biggest share for these two reasons. And I think, like Susan was mentioning, I think that once a scheme is introduced, it's very difficult to roll back, because also the reach of the scheme, like if you look at it from a little bit of a political lens, it's like half your voter base in the state. And it obviously influences the rest of the family as well. So we don't see rollbacks per se, but there is always tinkering with the criteria, with the inclusion and exclusion parameters that are there. In terms of frequency, again, like I had mentioned before, but just to give the overall breakdown, monthly transfers take up the biggest share. And I think that is for, again, two reasons. One is the efficiency of it. It's just like an every month kind of routine payment that goes out. And secondly, because a lot of the objective of the states are around consumption smoothing, around providing economic certainty, other outcome areas have not necessarily been brought into this, except for the farmer-centric schemes. So the other that you see here are the farmer-centric schemes, which typically provide benefits 2 or 3 times a year. So it's not one time or annual or monthly, but it's a varied frequency. The one-time payments are very small. Those are typically in cases of death of a breadwinner or in cases of institutional delivery. And annual is, I think, for very specific things like payments during the fishing ban, payments during the pollution ban that are introduced by states like Andhra Pradesh and others. If we do a deep dive a little bit into farmer-centric schemes, these numbers are for which we had budgetary data available. There are more farmer-centric schemes as well, and we'll get to that in the annexures. And some of this are spoken about, but most of these schemes are about supplementing the financial needs, because a lot of other tools have been tried out in terms of loan waivers, in terms of subsidies. But at least when we, from our lens, when we look at it, cash transfers are more efficient because loan waivers can be regressive. Like those who have taken loans from formal institutions like banks, etc., can kind of get the benefit of that. But the smaller farmers who have more informal loans, the smaller farmers who have more informal loans typically don't get the benefit of loan waivers. Also, it's sort of detrimental for the banks. It ruins the credit worthiness of the farmer. So loan waivers have not typically worked per se, and therefore the introduction of cash transfers, even if you look at early evidence from Raitu Bandhu, shows that it had a significant improvement in both the quantity and quality of harvest. We don't have, unfortunately, specific numbers, but just anecdotally, we were speaking to some PhD scholars in IIM Ahmedabad who have researched Raitu Bandhu. What they did is they looked at a few kilometers of harvest in Telangana, and then sort of did a control with the same few kilometers on the other side of borders with with the neighboring states. And they see that the quantity has gone up because of being able to buy the relevant inputs, but also the quality has gone up. And this is something we've seen in our projects as well. The quality is influenced, and this was surprising for us, the quality is influenced by the timing of the money. What I mean is that credit sometimes can be untimely, right? Like you've applied for a loan, but you don't get it in time. Whereas agricultural processes need to be done very systematically based on the weather. Like if it has rained, then you have to sow, you have to have weeded out stuff before. But if you've not got the money from the money lender or from the bank, then those processes get delayed, compromising the quality. But if you have money in hand, then you're able to do it as per the right process. And this is what we've heard from some of the recipients of our programs as well. So these are the farmer-centric schemes. PM Kisan, of course, is one of the largest because it reaches half the families in the country. I think the Kalia was the first scheme to introduce or include landless farmers. And so they shifted the criteria from land holding to cultivators, which is a big shift because a large part of our country does have more cultivators, like small and marginal farmers or farmers that work on other people's land. They had to do an extensive registry or a database of understanding who tenant farmers are. When we propose something like this in Maharashtra, the first question is, do we even know who the tenant farmers are and how do we go about that? And then PM Kisan also has some states providing top-ups, like Maharashtra provides an additional 6,000 to the PM Kisan. It's called Namo Shetkari. It's timed pretty much along with PM Kisan. So farmers get 12,000 a year instead of 6,000 a year. So that's the share of farmers, like a quick summary of the farmer schemes that we've looked at. If we look at the comparison, I think I covered some of this in the previous slide, but we have been looking at just design differences to say PM Kisan is 2,000 rupees at different points in the year, not necessarily linked to sowing season or anything. And this has two impacts. For the small and marginal farmers, I think any amount additional to their disposable income has a significant impact. For others, it may or may not be so. But the objective of providing support for the sowing season, we need to look into that, whether disparate timing really impacts that particular objective or not. Kalia and Raitu Bharosa, like I said, are timed correctly, but the difference between Kalia is that it was the first scheme to include landless farmers, whereas Raitu Bandhu now this year has introduced an additional scheme. So far, it was only for landholding farmers. It also becomes a little more regressive because the larger land parcel that you have, the more amount you're getting, which means richer farmers are obviously benefiting more than smaller because it's pegged to per acre. So you get 5,000 rupees per acre twice a year. And so it did get a little bit of criticism in terms of benefiting more richer farmers. When we look at women-centric schemes, we've looked at 14 schemes. These are typically the monthly transfers that are being provided. Most of the objectives, like I said, are about empowering women financially and nutrition. But I think there are not many studies. It's also fairly new, but there are not many studies to say, when you say empowering women, what metrics are you looking at? Like, what does empowering women mean? And therefore, how do you kind of look at whether the scheme is being able to achieve its objective? There are also unintended benefits or disadvantages of schemes. People have been raising questions on inflation, on labor force participation. Global studies show that it doesn't really have an impact when you do schemes of this nature, but we don't have any specific evidence in India based on these schemes, whether it encourages labor force participation, discourages it, what happens to inflation. The eligibility criteria for the women's schemes has been pretty much on age. So because you see that in the earlier life cycle of girls, there are other schemes which are incentivizing education, delaying marriage. So you have those schemes given at different milestones of education. And therefore, these schemes typically start at 20 or 21 years of age when other benefits have kind of ceased to exist. And it goes up to 60 or 65 because that's when pensions kick in. So this is basically covering for the middle period of a woman's life. The exclusion criteria is based on paying income tax, having any government job. Some states also have it on assets, like if you have a four-wheeler, then you're kind of excluded. How these are being done is something that I still need to look into, like how are they able to map? Because what we're also seeing is that if it is based on like the ration card, or how do you identify which is a family unit, people have started splitting their ration cards to be able to avail of schemes. So I think that implementation piece is a little bit hazy at the moment, how states are actually doing it. like I said, 14 schemes is where we have the budgetary data, but overall we have identified 20 schemes, of which 16 have a monthly transfer frequency. There are some which have others. One big one is Subhadra Yojana, which provides benefits 2 times a year, and I'll get to that on the next slide as well. The amounts here are also very interesting because they range from 500 a month to 2,500 a month. And for me personally, it's that is one area that I'm most interested in, is to say how are these amounts being arrived at. I think some of the observations here are that Subhadra Yojana, the interesting thing about Subhadra Yojana is that they changed the design very early on. So before the election, Subhadra Yojana was promised as a lump sum of 50,000. It was to be provided as vouchers to the women, which were redeemable anytime in 2 years, which meant that they would get the entire amount upfront whenever they wish to. Just after the election, it changed. It is still 50,000, but it's 50,000 over 5 years and broken into 10 installments. So instead of a 50,000 lump sum, you're getting 5,000, 10,000 a year in 2 installments of 5,000. We were very interested because if it was 50,000, it would give us evidence at scale to see what happens when bigger amounts are provided. But that obviously changed. Subhadra Yojana is also was meant to test out, do a pilot test with CBDC, with digital currency. Again, there's not much information on how that pilot went or what were some of the results from that pilot. But CBDC was, again, it's looked at in 2 ways. One is that programmable currency kind of dilutes a little bit of the unconditionality because you are then able to program it to very specific aspects that the government probably would want to. But again, we don't have much data on what happened to the CBDC experiment. There is only one sort of very well-known study on the outcomes. A lot of papers look at reach and look at some prima facie evidence on what happens with the scheme. Lakshmir Bhandar is the only one that has been studied by Pratichi Trust. And it speaks about how the money is being spent on routine expenses, which is again unsurprising because you're getting the money every month. And so it gets one of the big factors of monthly transfers is also behavior change, because then you you're accounting for that money in your monthly budget, and therefore you do shift to better consumption. You shift to more smoothened expenses in some ways. What Pratichi Trust has also highlighted is that these schemes do not help with domestic violence or child marriage. But that goes back to my previous point to say that if the objective is not defined, then these are the kind of findings. But ideally, a monthly transfer cannot help with these 2 things, right? So that's the space that we have looked at. And then, like I was mentioning, there are some states that have introduced schemes but not been able to implement, like Haryana, like Delhi, like Maharashtra had also promised a 600 rupees top up if the new government came into power, which has not happened. So it continues to remain at 1,500 instead of 2,100. And when we look at a comparison of schemes, what we see is that Lakshmir Bhandar is one of the earlier schemes that was able to provide benefits, like additional benefits to the SC/ST communities, looking at the vulnerability indicators. But the flip side of this also is that the reach or the uptake for the SC/ST community is low. So while it has been designed intentionally, the implementation has not been able to match up to that. But it also sets a precedence for other states to look at. With Gruha Lakshmi, and I think you guys know Karnataka a little better than us, but with Gruha Lakshmi, it is to women who are heads of households. I think at the time of introduction, that caused a little bit of confusion in terms of how do you really define heads of households? Is it only based on the ration card, or how does that get defined? And with Subhadra, like I mentioned, it is the only scheme that provides benefits twice a year. The interesting thing about Subhadra Yojana is that the twice a year is Raksha Bandhan and Women's Day, which is very, again, curious to us to say that, sure, that's a woman narrative, but really does it link to the needs of a household in any way? So those are some of the really obvious things that we think can be designed a little bit better. And because I've been speaking about amounts throughout, I'll deep dive a little bit into this. Is we were looking at what are some of the things that amounts can be potentially benchmarked to, and MPC is what we thought at least is a good starting point to look at. Uh, Nowhere are we saying that we know what the right, is it 30% of MPC or 50 or 60? We don't have an answer to that. But at least this table provides us an understanding to say that a large part of the schemes provide less than 30%. Now we need to deep dive into understanding whether that 30% is enough or not. But further than that, when we spoke to some more experts, it's to say that are these numbers, is MPC also valid sort of benchmark? Because if you look at other, other economists who've looked at consumption prices, who've looked at the calorie intake as it's supposed to be ideally, these amounts are also supposed to be higher. Like, is this consumption um, is the consumption expense reflective of the fact that people are not able to earn? So is this the ideal consumption anyway? And so this is an area that we want to deep dive further into, because the range of the amount is really wide, right? Like starting from 2,400 a year, which means 200 rupees a month, which is what pensions provide, to 2 lakhs a year, which is more for death of family member kind of benefits. The only schemes that provide more than 100% of MPC are in states like Haryana and Andhra Pradesh. Like Andhra Pradesh has really high pension amounts. They provide 4,000 rupees as pension to senior citizens. For people who are completely disabled, the amount goes up to 15,000 a month. So those are the schemes that are really on the higher end of the spectrum. Again, not to say that that's the ideal amount, but needs to be looked at as to what that sweet spot really is in terms of the vulnerability that you're trying to address. And finally, when we get to implementation, I think citizen level challenges is something that is most spoken about in terms of awareness, in terms of access, in terms of really clarity as to why payments are being halted or why they are being started. Maharashtra being case in point again, because while it's supposed to be 1,500 a month, a lot of the payments are lumpy. It started off with one big lump sum of 7,500 when the scheme was announced, because it was paid retrospectively. And even now you see that because they're cleaning up the list of beneficiaries, payments are halted for some months and then provided as a lump sum. But these are not really communicated. So the objective of having money in your bank account every month is kind of diluted. There's also confusion about Aadhaar seeding. There is less financial access. I won't get into citizen challenges because I think those are something that we speak about more often. But the interesting thing to us was 1 and 3, which is inoperative accounts. That while Jan Dhan, we talk about the penetration of Jan Dhan, there are still 10 crore accounts that are inoperative. Inoperative could be for a range of reasons, like citizens not knowing that money is coming into that account. Like that's the one that is Aadhaar seeded. It could be for citizens who have like passed away and like that's just the accounts have not been shut. It could be for a range of reasons. These can be very easily activated again with a simple KYC, but it's to see where is the break point. Like, is it just lack of knowledge? Is it lack of access? Or what is it that is kind of causing this thing? But because there are so many inoperative accounts, the amount of unclaimed deposits is also huge, more than 40,000 crores. Which is to say that if so much money is being pumped by the system and a lot of it is lying unused, then again, it kind of dilutes the impact. So again, links back to impact assessment. The DBT framework is also something. Here is the only place we've looked at some of the conditional schemes as well, to say that when DBT mission had come up, there were specific guidelines in terms of institutionalizing PFMS, IFMS to enable that the direct benefit transfer. But in many states, pensions are up to like 2 to 3 months delayed because it's not really direct anymore. It's going through certain channels. And I forget, there was one scheme. There was another example which I'm forgetting, but the back end also needs to be looked at when we think about implementation, because not all states are at the same level of having adhered to the DBT guidelines. Tamil Nadu is one state that is far ahead because we do know that they have very, very strong databases in terms of who are the eligible beneficiaries across schemes. States like Haryana, Rajasthan are looking at the family IDPs to say that what is the concentration of different schemes within one family and how can that be streamlined or consolidated, to say that if there are 10 schemes for women, how can that be, if one woman is having to enroll for 10 schemes, having to understand where the benefits are, how it's being achieved, can it be consolidated? But these are all very, very early efforts. We don't have evidence on what works or what doesn't work. As we did all of this, I think a few things that stood out for us to say that if this space is likely to grow, what are the things that can be done to strengthen it? And the first one is just consolidation, because what we typically see is that governments can introduce schemes, but they find it very hard to have a sunset clause. There are schemes will stop having allocations and they'll taper off, but the schemes don't close. So suddenly in another year, you'll see that it has an allocation. Maharashtra, for example, has 3,000 schemes. So how do you kind of, like Muzamil likes to say that for any organization, how can you have 3,000 products? Like you can't efficiently administer it. You can't have efficient resource allocation as well. So can this 3,000 really be consolidated? It's not a new idea. I think people have been talking about how regressive subsidies are, how it can be phased out. But now that cash transfers provides that alternative solution, it provides that ability to really consolidate without leaving people behind. I think the conversation becomes much more relevant even now. Design is what the FACT framework, like how can we build a more common framework or guideline from which states can actually pick up ideas and then use it to bring in other groups into the conversation as well. I think the identification of the extreme poor is something that, if you look up what is extreme poor, you'll get like the multidimensional poverty or the global poverty line. But that's not really reflective of how poverty is experienced in India, because you could also have cyclical poverty where people, like today you may not be in poverty, but something pushes you down and then you're up again. So what is the way of defining and identifying poverty is something that is needed, because otherwise a lot of these welfare schemes continue to remain don't continue to not reach the extreme poor. Like even now schemes are reaching 70-80% of the target population, but it's the 20% that actually are left behind who need it the most. What we're also looking at is, and I've covered some of this before, so again, sorry for the repetition, but can we move from a safety net approach to a trampoline approach? Like, can we move away from providing, not move away, but expand from providing economic certainty to say that if we provide the ability to create foundational assets to build better livelihoods, it can build self-reliance and sort of build the ability of citizens to move to more aspirational welfare as opposed to just being in that safety net zone. And then I think monitoring and evaluation needs a lot more thrust for all the above to be actually valid. We also had some open questions which link to the way forward. But I will pause here for questions from all of you and not only on what I've presented, but on what you think the way forward can be, or what are some of the things that you think should be prioritized to make this space a much stronger tool in itself, but also as a part of the overall welfare agenda.